Well, the U.S. Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures Price Index, rose last month at its fastest pace since June, an alarming sign that price pressures remain entrenched in the U.S. economy and could lead the Fed to keep raising interest rates well into this year. Friday's report from the Commerce Department showed that consumer prices rose 0.6% on a monthly basis from December to January, up sharply from the 0.2% increase from November to December. On a year-over-year basis, prices rose 5.4%, up from a 5.3% annual increase in December. Excluding volatile food and energy prices, the so-called core inflation rose 0.6% from December, up from a 0.4% rise the previous month. And compared with a year earlier, core inflation was also up 4.7% in January, higher than the 4.6% annual uptick in December. The report also showed that consumer spending rose by 1.8% in January compared to December after falling the previous month. Now, January's price data exceeded forecasters' expectations, confounding hopes that inflation was steadily decelerating and that the Fed could relent on its campaign of rate hikes. It follows other recent data that also suggested that the economy remains gripped by inflation despite the Fed's strenuous efforts to tame it. Well, can the Federal Reserve keep raising interest rates and defeat the nation's worst bout of inflation in 40 years without causing a recession? Well, not according to a new research paper that concludes that such an immaculate disinflation has never happened before. The paper was produced by a group of leading economists, including Stefan Cassetti, a professor at Brandeis University, and a former research director at the Federal Reserve Bank of New York, and also Frederick Mishkin, a former Federal Reserve governor. The research paper reviewed 16 episodes since 1950, when a central bank like the Fed raised the cost of borrowing to fight inflation in the US, Canada, Germany, and the UK. In each case, a recession resulted. Rate hikes by the central banks like the Fed make mortgages, credit card borrowing, and business lending more expensive. Steadily more expensive loans can force companies to cancel new ventures and cut jobs, and consumers to reduce spending. It all adds up to a recipe for recession. Now, other economists have pointed to periods when the Fed successfully achieved a so-called soft landing, including in 1983 and 1994. Yet in those periods, the paper notes, inflation was not nearly as severe as it was last year, when it peaked at 9.1% in June, the highest in the U.S. in 4 decades.
The labor market has remained extremely tight, with the unemployment